Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. Fed member speeches are important since markets look to these important people to give further guidance on rates. It's similar to having a conference call with the management of a company to get an earnings guidance. It was not just Fed member speeches, but also falling bond yields and falling oil prices driving the markets. Good morning, JK. What are your thoughts on the recent moves?
Good morning, Swaraj. Yes, it's a good analogy between management of a company and Fed members speaking. Yeah, both of them will speak what is in their interest, and the Fed members' interest is obviously to see that inflation falls to their target, and that is why when you see their language, it's still not overwhelmingly dovish. They're very guarded on the inflation falling, and they say we are still away from target, and therefore try to push back on the market's elevated expectations of earlier rate cut by the Fed. So that's what we are seeing from the Fed. But in the meantime, we have more signs of US economy slowing, particularly the forward-looking indicator like Philly Fed Business Survey, which dropped to minus 2.1 from 9.2 in November. That's quite a drop. Prices paid component also dropped from 23.1 to 14.8. Again, some more indication of inflation falling. Employment component was also down. The monthly industrial production data for October showed a minus 0.6 from a revised 0.1% rise in September. And of course, it was affected by auto workers' strike as well. In another sign of easing jobs market in the economy, weekly jobless claims as on 11th November rose to 2,31,000 from 2,18,000 on the previous week, and expectation was around 2,20,000. But a more telling fact is the continuing claims also rose to 1.865 million from 1.833 million. And as we have been explaining in our various updates, continuing claims are an indication of job market softening, because people who go out of jobs find it difficult to get back into their jobs. Now there are indications that market actually discounting a 62% chance of at least a 0.25% rate cut by the Fed in May. That's quite a big leap in the expectations on the rate cut. But at the same time, there are some analysts who caution about this, and this is the seventh occasion on which markets have priced in a swift shift by the Fed in rate cuts. On previous 6 occasions, these expectations have been unwound, and will it be different this time? We have to wait and see. On the risk assets, investors are obviously encouraged by the lower inflation leading to fall in yields, but they also remain cautious about the economy slipping into a sharper slowdown. Hence, a bit of circumspection is warranted. So stocks have consolidated after a good rise in the last few days. Dollar index has had a sharp retreat from its recent high of 107.35 to 104.01, starting with the unemployment report, which came weaker, and then getting further pushed down after the CPI numbers and more set of weak numbers. But we do have consolidation that's going on right now. Key level is seen as 103.80, and any push below 102 would definitely give a big momentum to the dollar index towards 100. And euro and GBP have been performing much better than most other currencies, as despite their economies showing weakness. But this is more down to the dollar diversification that we have been seeing as an ongoing thing. And yesterday we did have the gold also rebounding strongly above 1980, and it had a healthy consolidation after touching about 2000 a few weeks back, and that corrected the 10% rise that we had seen in the last 1 month. And now it looks like we are ready to attack the 2000 level once again. But the bigger move happened in the crude oil, which fell more than 5%, striking a 4-month low during yesterday's session. Crude slumped after the trend following traders pushed it lower. Also losses accelerated by swelling inventories and failure of key technical supports. It maybe Brent is headed to 70, which was the previous low in the latest cycle. And of course, we have been mentioning about key meeting between Chinese Premier and Biden. There were a lot of positive statements on improving mutual relations, but no concrete agreement on any specific issues were announced. As far as the rupee is concerned, the push to 83 or slightly below that was very short-lived, and we saw good demand emerging at 83, and then came the trade number, which we explained yesterday, that has seen it almost touching the previous range high of 83.25. Yes, PSU banks have been there offering dollars, but the demand is not vanishing. So, and in the context of not having enough flows, we can't expect rupee to perform in line with the others, whereas we have seen big moves in like Korean yuan, which has strengthened by more than 5%. The IDR, which probably has better correlation with INR, has also improved by 3%, but INR stays at its close to its weakest level, down to its own domestic factors, and not following most of the other factors. Good thing is that FI flows have become positive for this month, almost 1.5 billion, most of it coming for the bond market. And unless we see a big inflow coming, as we have been saying, don't see a break of 83 on the downside, despite most other factors, particularly on the global side, supporting such a move. So content with 83-30 range, perhaps till indications about the state election outcome. Thank you.
Thank you, JK. And yesterday's language of Fed members was very guarded, trying to push back on an earlier rate cut. Monthly industrial production data was negative, but things to keep in mind is that there was an auto sector strike also in the US. Further, jobs market data was on the weaker front, keeping yields lower. Gold rebounded and oil fell more than 5%. For USD/INR, we saw good demand below 83.10, and it pushed it higher to higher back into its old range of 83.23-24, where we have been observing state-run banks continuously offering. That's it from us today. Have a very good weekend. Tune in on Monday for the latest in the financial markets.